All right. Well, good morning, everybody. Welcome to Enhancing the Accountant Bookkeeper Connection series. And for those of you who don't know me, but I think everybody probably knows me by this point, that's myself, Tanya Hiltz, certified professional bookkeeper and founder of Cloud Business Services and Tanya's Bookkeepers Bootcamp. A little bit about myself. I was Insightful Accountant's top Canadian ProAdvisor for 2020, Insightful Accountant Top 100 ProAdvisor for 2018-2019, CPB Canada's 2019 Professional Leader of the Year, Practice Ignition's Top 50 Women in Accounting 2018 and 2019, and of course, there's a few others. You guys can all read it. I'm not going to go through it all. Okay, so this webinar will be submitted. I'll be submitting that later today for continuing education credits through CPB Canada. There will be 2 polls and both must be answered in order to qualify for the credits. A recording of the webinar will be emailed within 2 days and certificates for the credits will be emailed within 2 weeks of receiving approval. So KATA Accounting, so we've been collaborating with Jonathan and his team for a number of years. We have multiple mutual clients together. What I love about Jonathan is he works in QBO, and it is so nice to work with an accountant who works in QBO and understands it. Just makes things go so much smoother. They have great attention to detail and outstanding customer service. So yeah, you can take it away and take over, Jonathan.
Well, thanks, Tanya. Hi, everybody. Today, I have pulled out an older presentation that was done at the end of last year and adapted it for the new reality, the COVID that we live in. Just a couple quick things about me before I get into that. And just so I'm clear on who I'm speaking to, can you just type yes if you saw this presentation last year, please? I'm just curious as to how much of it will be repeated material for people and how much will be brand new. So I am the founder of KATA Accounting Solutions Professional Corporation. I was a member of the inaugural Intuit Accountants Council and have a long-standing relationship with Intuit. The Accountants Council was a group of accountants and bookkeepers that were asked to help kind of form a committee to help give feedback and steer the direction of Intuit product, both on the tax and bookkeeping side. I was the recipient of the 2018 Inspire Accountant Award. Very flattered that came from y'all, like came from bookkeepers who nominated and voted for me, and it really means a lot to me, that particular item. I am an elite ProAdvisor, a QBO Advanced Certified. Our team is required. One of the first things everybody does is become basic certified, and then within 6 months to become advanced certified ProAdvisors. I am considered a trusted advisor for several cloud bookkeeping firms, and a thought leader in technology and accounting. And we love working with technology companies. Most of our clients are in the digital marketing space in some way or another, be that videography, actual digital marketing campaigns, things along those lines. Apologies for that. I'll just turn that off. Our tagline is to communicate, collaborate, and innovate. We find that the biggest thing missing in the client accountant relationship is communication. So we really try to do a very good job on that. And as I've learned over the years, it's something that does require continual improvement. So why provide a beautiful year? This is the agenda for today. First is why to provide a beautiful year-end file. Then we'll talk about the general information that needs to be included. The balance sheet items, the assets, liabilities, and the key accounts that often get overlooked, some of the challenges that we've seen over time. Then income statement account items, the key accounts there, and we're going to talk a bit about in each section about the key accounts with relation to COVID. So it does sound like a lot of people, maybe about half the audience has seen this before. And no, Kim, I can't hear you crunching on your ice. So let's do our first poll question. Haven't given the answer yet, so kind of a challenge, but why provide a beautiful year-end file? A, to look like a superstar to your client and your partner accountants. B, to minimize the back and forth with your client and their accountant. C, to ensure you have the proper documentation of transactions. D, because you're legally required to do so, or E, A, and B. So give everybody a couple minutes.
Yep, and just a reminder that you do need to answer both poll questions in order to receive your CEC credits. Perfect. We got 100%. So we'll just close the voting now. So we'll end polling and share the results.
A and B would be the correct one. I mean, it's kind of, it really does help enhance the relationship and make you more referable when you provide that beautiful year-end file. So these are some of the things that we had identified. Help keep the cost down for your client, help keep them happy, and importantly, keep them out of trouble. That's going to be extremely important over the next 5 years. I think COVID has provided the next decade's worth of work for accountants and bookkeepers. We're going to be facing God knows what with regards to audit and compliance in relation to the COVID programs down the road. It does enhance your relationship and reputation with the accountant and with the community. If you have a reputation for providing good year-end files, you become easily referable. It mitigates the back and forth you should have with a good tax accountant. Now, of course, there are accountants who will ask the same question 4 times, even though it's been answered, it's in the numbers. I've been guilty of that as well. Doing it once and doing it right makes your life easier. And the thing that we find is different bookkeepers, different accounts like to work in different ways. Figure out how your partners want to work with you and work together. This presentation will just kind of talk about the meat behind what should be provided, not the form, but the substance. So, of course, all of this is especially important this year with the COVID programs. We can't discuss every possible situation, so we're going to try and cover as many of the basics as we can. So, general information that's required. So, basic identification: who owns the business, who's signing the tax return, those kind of questions. I prefer to see a shareholder register. I also like to see a list of directors and officers, if there are any related corporations, and of course the key identifiers. Now, the nice thing about QuickBooks Online is most of the stuff can be kept right in the company information, which really makes it easy. We do need to know if there are any major events. If there was a change in control, it can result in a short year end, depending on incorporation dates and when the set year end is. There could be a stub year end, like a short year end at the beginning to get people on the correct track. Or you could have a year-long tax return, get approval to change your fiscal year end, and then have that stub period to get on track with the year end that you want. So it's very important to know if there were any major events. Those could include other things like a sale of assets. If you sold, it could be anything from fixed assets to a book of business. That's very important, and those agreements are very important. Issuance of shares, issuance of dividends. Make sure that minute book is kept up to date. Keeping the shareholder register and the minute book up to date are legal requirements that we find are often overlooked. And these are small areas where value add can be provided. There is no law saying that you have to be a lawyer to do a minute book. In fact, quite often I'll find minute books when they're being kept up to date, are just following a lawyer's instruction and being done by the shareholders themselves during their annual meeting. Just a reminder that all corporations are supposed to have an annual meeting within 6 months of the year end too. So another major piece this year that we want to know is what COVID programs has the customer taken part in. SEBA, this one is going to be more for the future. This is the $40,000, possibly expandable to $60,000 line of credit that could be 25% forgivable if repaid by December 2022. When this happens, if that income is forgiven, if that line of credit 25% is forgiven, then that will become another income and will be taxable. Temporary wage. Yep.
Sorry, if I can just jump in on this one, that
I'm glad. Yeah,
CRA,
please do,
yeah,
because we need as much information about these things as we can. Yeah.
yeah, absolutely. And of course, I think anybody who knows that I've spent like half of my last 6 months on CRA calls. So they've actually clarified this, and I had some huge issues around it, and it's been since re-clarified. So the SEBA income, they do not want to wait until December 2022 to make sure that it is forgivable, or the amount. They want the amount claimed within 2020 tax year. So that way it's claimed against the year that the expenses were put through, which makes sense. As long as it's in 2020, it doesn't matter. Like, so if your year end, so my year end, for example, that, you know, Jonathan's team is doing, is on August 31st. As long as it is in the books as of 2020, so I can even put December 31st, 2020, move it over to income. Then if it turns out that the full amount is not forgivable because it was, you know, repaid late, or I repaid early, or I didn't use the full amount, then that is to be offset down the road. And they've
Interesting, because
confirmed that.
it makes sense with regards to gap, but with actual timing, or ASPE, but with the actual timing, it really kind of violates that as well at
Well,
the same time. It's interesting.
it does, because that was my issue, because I said, if I have a credit card statement and the credit card statement is showing that the loan balance is still due of 40,000 and it's not forgivable, I'm like, it doesn't make sense. And yet it does. But so yeah, I argued with them quite a bit, and I argued with several different people. And it's now, I'll find the link where it is on their website,
Yeah, I'd
that says
appreciate
that. But
that, because I definitely need to update this then.
absolutely, yeah. Essentially, the purpose was because they wanted to go in the same period to offset the expenses. So gap is what they fell back to. And then this way they're guaranteeing, because they don't want to continue. Another reason is for the audits. They don't want to continue and do audits several years down the road. They just want to deal with all the audits all once, all at the same time. So from that perspective, that makes a lot of sense as well. But yes, while you continue on, I will find that link. I will put it in the chat, and I will send it out with the email.
Awesome. Thank you very much.
Yeah.
So a few more of the others, the TWS, CEWS, I'm sure this is one that everybody's dealing with. TWS was pretty basic, pretty simple. Accidentally hit my button there. Maximum of $13.75 per employee to a total maximum of $25,000 as a temporary wage subsidy that was remitted, well, not remitted, but held back from source deductions, and that's how you collected that subsidy. The CWS is all right.
Okay. Only because there's been a lot of questions and chatter on this on the on some of the Facebook groups within the last couple of weeks. With regards to that, just to clarify, and again, I've got the links, is that some people, if they had, and it was mostly the shareholders, were maxing at the 1375, they were actually not calculating anymore because they said that person was maxed. What it is if you have 10 employees, so as Kathy said, it's actually times the number of employees, not per employee. So the wording was very it wasn't quite clear and concise with the wording, but again, that has been confirmed. So if you've got one pay, you've got 9 employees, another pay you've got 10, then you've got 11, then you've got 13, and then you've got 8. Essentially what it is, it's the maximum number of employees. So that we would take 13 times 1375 is the maximum. We do not look at it at an employee level. It's just 1375 times the maximum number, or the number of employees on the highest pay within that period. So that's one to clarify. The other thing that people have been asking about is a lot of people don't seem to be aware of the PD27. So there is a PD27 that is out that has to be filed essentially by tax season. I would suggest doing it before your December liabilities are due, because that's essentially going to reconcile to make sure that everything was claimed properly. If you've got clients that you did not claim it because you claimed everything on the CUs, that's fine. You can submit your PD 27, just simply stating that you're not claiming, here's what was eligible, but you're not claiming anything. The reviews are very easy. I've already been through reviews on that. And essentially it's just a quick phone call just to verify if, you know, the numbers aren't matching. Say, okay, yep, we're going to mail you the difference, or yep, it was claimed on CUs. They just do a quick verification and it's done. But that PD 727 does have to be filed. And again, the benefits of doing it before your December liabilities are due is if there's any adjustments, you can just make it nice and clean on that last to avoid a peer review. And that's all I have to say on that.
Okay, awesome.
Okay.
The CWS, the emergency wage subsidy, that one is evolving a lot, so I didn't bring up all the details about that. It is going to be very much on a case-by-case basis with regards to, you know, at a certain period, you have to pick one method or another and use that moving forward. And I know there's a lot of organizations doing calculations to try and determine which method they want to use. But regardless, those items, that discount essentially that you're getting through TWS, that subsidy that where you're actually getting money from CEWS, those are taxable income. They need to be listed as other income. I would prefer in the files that I see to see these in separate accounts, completely separate accounts. The CCRA, I haven't seen a lot of reporting requirements about it at this time. I'm guessing it's going to be something along those lines of you'll have your rent expense and you'll have a contra rent expense for the amount of discount that you end up receiving. And then, of course, you know, the pandemic continues, the programs are evolving, and who knows what's coming next. Tanya, was there anything you wanted to jump in about? Did I miss any major programs that you're seeing with regards to people participating in?
Yeah, so there's the CERS, which is a Canadian Emergency Rent Subsidy, which was officially approved late Thursday night. That applications did open on Monday for that. I actually have a webinar that I'll be attending on Thursday. So once I get more details, I'll be posting those out in Bookkeepers Corner Facebook group as well as the Get Intuit Facebook group. So that's again where anybody can go to look for the information that I'm regular posting. With regards to the reporting, because that goes back to September's, you know, I'm assuming it'll probably just be either a contra account or again as other income, which with the CUs, what I've done is I've created another income account and actually called it COVID subsidy. So that way it's extremely clear. And any of these subsidies are actually not to be included. I think everybody knows it by now, but are not to be included in your calculations for like your revenue calculations for anything.
To
And
apply for your
yeah, and that's it. And the
subsidies.
CUs, all of the companies all the payroll companies are coming out with modified T4s. We do know that there's going to be a box number for each CU's filing period. So for each of the employees. So if you have not already been tracking on a T4 level, like on an employee level, I would highly suggest to do that. I know in boot camp, we've taken the government forms and added a couple extra forms for kind of audit proofing. And we've actually got that included already because I knew that was coming. So we just set that up and so it's going to be really easy to pull it apart. If you don't have anything, just fall back to your original CU's calculator. Hopefully you've been using the government spreadsheet because it'll show in there what employee per period for reporting on that.
Yeah.
And that's
Just
kind of
one thing that I'd like to add. Sorry.
as I said, that's all I know at this point.
Just this is my preference. I don't believe there's a requirement for it at this time. I would prefer to see each type of COVID relief program to be in its own other income account, just so that it can be very clear. This is related to CEBA. This was related to SUS. This is related to TWS. Things along those lines. And I think in the end, when the government does come back to look at these things, having them in segregated accounts will help. It will help. All right. One key thing that we'd prefer everybody do before providing any data to any tax preparer is to lock the books. Lock the books before you start reviewing so that nobody else is changing the numbers while you're reviewing it. Nothing worse than, okay, you're working with this data set, and then you go back to make your adjustments and the data has changed. And you've got to kind of start the process all over again. So use that lock feature. I would suggest using it every month once you've reconciled the books, and to be cautious about reopening past periods, and just getting that good pattern of behavior. And I mean, it'll help the flow of the bookkeeping processes immensely as well. So onto the balance sheet. Let's start with reconciliations. This is an area where we've seen a lot of different little challenges. This is a bit QBO focused. So, just so everybody's aware, your bank accounts and credit cards need to be reconciled. I really get bothered when I log into a QuickBooks Online file that I'm told is ready, and I see there are unreconciled accounts. I'm even more bothered when I look at those account balances on the balance sheet or trial balance in QuickBooks and on the statement, and they're nowhere near the same. That tells me that really, really has to be done. I don't consider the books closed until the accounts are reconciled. Just note that the reconciliation report in QBO is a snapshot. So if you do make changes after the fact, they won't be recorded on that snapshot. So we've seen times where the books were reconciled, the reconciliation report is sitting there in QuickBooks, we can go look at it. But when we look at that, the register balance on that report doesn't tie to the register balance in the balance sheet or the trial balance. And that's because of that snapshot that's taken when you do the reconciliation. Our recommendation of reconciliation should be really rather easy in QuickBooks most of the time. I love it when you get them and they're all green. It's just like, yeah, finish now, finish now, finish now. And it can make it really easy. So I would recommend undoing and redoing the final reconciliation at least to make sure that one ties, because that's the one that any tax preparer is going to look at. Provide the third-party statement so it can be verified, preferably a statement and not a screenshot or printout of a CSV file or something like that. If you're using HubDoc, that's a great thing. Just give the person access to HubDoc. If they know how to use it, they can go and find what they need to do. If you're not comfortable sharing that volume of data, pop it over to them and share. Was it share file you use? I think, Tanya, or OneDrive or whatever other method you want to do. Before you send the report, make sure that the bank balance ties to the statement and the register balance ties to the balance sheet, and that there's nothing more than 6 months old outstanding. That's one of the most common things we see when there's a big discrepancy between the register and the bank statement, is that there are old transactions that have been sitting there sometimes for years, especially if somebody's doing their own bookkeeping. You can have stuff from like 5-6 years ago. So just some reminders: checks more than 6 months old should be stale dated. Hanging transactions are usually errors. Either something was entered and did not actually happen in that account, it was entered incorrectly. Sometimes we found that things can get entered twice, particularly if you process from the bank feed and then something is submitted, say, through Receipt Bank, and then it comes in, it can create a duplicate transaction. Regardless, there should be nothing more than 6 months old in that report that is not cleared. And I would recommend validating any transaction that's 6 months, but that is still uncleared on the reconciliation report. Are there any questions about reconciliations right now, or just gonna pull open my chat box? Doesn't look like it. Okay. Moving on. Accounts receivables, have all receivables been appropriately matched? I have seen horror stories where the customer is creating invoices and the bookkeeper is recognizing deposits as sales, resulting in double sales and massive matching problems. It can create quite a headache and, of course, way more taxable income than is justified. Don't process the money received directly to sales. I would strongly recommend that if you do see money coming in, you don't know where it's from, that you find out before you move it into a sales category, because it might be all kinds of different things, right? A refund on an expense. It could be a COVID related program. It could be all kinds of different things. But yeah, it's important that receivables be tied to the sales as the deposits are coming in. So also the bad debt, has there been any bad debt identified and written off? And has it been documented why it was written off and the justification for writing it off? There are some justifications. I have seen a lot of times bad debt just be written off, and you can't just do that. There are some requirements to you have to show that you've tried to collect it, that it's proven to be uncollectible. Those kind of things have to be done before you can just write off a bad debt. Prepaid expenses. This is an area where we often find there's stuff hanging around. This usually includes things like the security deposit on rent, on utilities. Insurance is a common one because you'll pay for 12 months, say in the middle of the tax year, and it really should all go into prepaid expense and be absorbed over time to satisfy the matching principle. Lawyers' retainers is another common area. Ideally, what I would like to see in this is a list of what is contained in prepaid expense and what the amounts are, the items are, and where they come from, like the date and so on. Inventory, this is an area that's definitely a little bit interesting in QBO. QuickBooks will not allow you to lock the file if you have negative inventory. I would recommend looking at your inventory if you're using that module. Make sure you write off spoiled and stale inventory, but make sure that your supplier invoices are going in correctly so your inventory is going up appropriately. And if you are making adjustments to inventory, make sure you know where that's going. I've seen quite often people make those adjustments directly to retained earnings or opening balance retained earnings or even shareholder loans. And of course, that's not the appropriate way of doing it. You really do need to track as to what happened, where did that misstep occur before, and that's where it should go. Does the inventory balance make sense? I've seen a number of times where I've received books with inventory balances in credit, in a credit balance. Well, you can't have negative inventory. It doesn't make sense. Has there been a count? Has the inventory been trued up to that count? This is an important area because especially if it's something that's valuable, this is one of the most common areas of fraud and theft. Whether items are being sold by an employee for cash under the table, being taken out of inventory, the cash is never coming into the company. This is quite often where you'll notice some things like that. Okay, Kathy Badgery, Jonathan, what do you recommend for when a source transaction is never recorded in the bank, but you have a valid source doc? Maybe you could expand on that for me a little bit. I mean, the money should be coming from somewhere, or it's going into the shareholder's pocket, or there's a potential fraud or theft going on there based upon what I'm reading, but maybe a little bit of clarification will help me there, Kathy. Go on to the next section while I await a response. So fixed assets, I would keep a fixed asset register that is an outline of what fixed assets the company owns, where they are, serial numbers, things like that can definitely help when it comes to insurance, should there be damage related to a fire or a flood or something like that. Make sure that the assets are all still operational and in use and still exist, especially when it comes to things that are easily walkable, like a laptop. It's quite possible that laptops get walked out of the building with a former employee or somebody who needs something for their kid or something like that. So make sure that they're all there. And then if you choose to create the fixed asset schedule and book the depreciation, you should show the additions, the disposals, and make sure your depreciation calculations are correct. There are many different ways of doing it. They don't all necessarily tie to tax. We personally, at KATA, we do tie to tax or attempt to tie to tax. Sometimes when you inherit books, it's not possible, but we try to tie to tax to just keep reconciling the two very, very easy. For intangible assets, create and keep a register as well. This is very important for shred claims and can be very important to valuing companies, especially startups. You have to ask if these assets should be impaired. Do you own an intangible asset that's really not worth anything anymore? This could be items like trademarks or intellectual property. For instance, I'm sure the IP on the VHS VCR is not nearly as valuable today as it was when right prior to its release, things like that. Loans, make sure that the current part is moved into current assets. If you're collecting a loan from somebody, make sure that collections are performed on loans. These often get forgotten if they're not part of the core business. And that ensure that the interest received is in the appropriate income account, not in the loan account. That will definitely screw up the balance and how much you think that you're still owed, and it will also mess up the income that you're declaring. Keep an up-to-date loan amortization schedule and make sure that there is a loan agreement in place. I'm going to take a quick pause. I see Kathy wrote some notes here. So the source expense doc has the bank account listed, but the transaction never clears the bank, and it's not a duplicate transaction. Debit card transaction does not clear the bank, and it is the company bank account, not the owner account. So you purchase something from a supplier, but it never actually left the bank. The company never actually paid for it. Am I understanding that situation correctly? Huh, that's an interesting one. Okay, so I am understanding that correctly. I would check with the bank to see if things are coming up to clear. If it never clears, then that has to be removed from the bank account, and it really becomes another income, right? Because you would debit the expense, credit, sorry, I'm backwards here. Debit the expense, credit the bank account. So you have to put that money back in that account and credit something else. That could be the expense category that was originally used. That would be my top recommendation for that. So let's move on. So current liabilities. Oh, I'm sorry, I forgot one key thing here that I want to see. Sometimes there could be a receivable related to a COVID program. Particularly SUSE is likely going to transition over year ends for a lot of companies. I would like to see that receivable in a separate current asset account, not listed in bulk with the accounts receivable. Again, no requirement for it, my preference for it. So to the liability side, accounts payable, very similar. Has it been reviewed in detail and cleaned up if necessary? Should anything be written off, and do the balances make sense? This is quite often where we see a lot of sloppiness, where you'll see, you run an AR aging report for year end, and the bulk of it looks appropriate, but then you have, 50 vendors listed with $1.17 here, negative 35 cents here, things like that. That really should be cleaned up and cleared up eventually. If it's never going to be resolved, take it into income or into the expense category that is associated with it. When things are less than $1, CRA generally doesn't look at those with any degree of detail. There can be a negative balance in AP where the company is owed a supplier credit. So that can be appropriate, but make sure that you record it appropriately and that you can explain that if need be. Accrued liabilities, these are kind of like the opposite of the prepaids. These are items where you haven't received the invoice or bill yet, but the expense does relate to that period. The most common item for this is, of course, the T2 prep fee. There could be other items such as legal fees. Again, create a schedule, explain these are the numbers that make up the balance, these are the dates, and these are what they relate to. Loans. This is an area where we're probably going to have more work in the near future because a lot of people are taking those loans. Now, luckily, those loans, the CFIB loans, are zero interest for a while. So just remember the current versus long-term portion of it. How much is due in the next 365 days versus how much is due later than that. And of course, ensure that interest is paid in the appropriate expense account, not in the loan account. Keep an up-to-date loan amortization schedule and make sure the loan is documented. The number of times where we see loans on books and we actually dig into them and find out that they don't belong to the corporation is actually shocking. Same thing happens a lot of the times with vehicles. We'll see a vehicle on the books and we'll start digging into it and we'll find out the vehicle is owned by a shareholder, not by the company. So those are things that CRA takes seriously. You need to think about investigating those and not just, oh, it's used for the company, so we'll just put it there. There needs to be some kind of paper trail to show that transition of the asset from the individual to the company. So some key balance sheet accounts that we've often seen issues with. It's important to understand these accounts and to make sure that you understand what's going on in them. I'm sure we're all discouraging the entanglement of business and personal transactions and shareholder loan accounts, right? Nobody's doing that ever. Debit balances can be forced into income on the shareholder's point and not deducted as a management bonus from the corporation. So the corporation pays full tax on that when they could have deducted that as an expense, and then the shareholder pays full tax. And usually when that happens, that is pushing the shareholder to the top tax bracket. I have never seen this happen for a smaller amount, but when I've heard of this happening, and I luckily, knock on wood now, none of our clients have had it happen to them. Anytime I've heard of it happening, it's been in the mid to high six figures are being forced into income. There are some ways to deal with this, but get a plan in place and work that plan. CRA doesn't care if the company owes the shareholder money, so don't worry about that, but make sure that the shareholder is getting paid, not just in salary, but they're getting those loans back. Keep a track of these accounts. The shareholder loan accounts need to be segregated. If I have seen situations where one shareholder is in a significant debit balance and the other shareholder is in a significant credit balance, and essentially what's happening is one shareholder is funding the lifestyle of the second shareholder, and the second shareholder is seriously putting company resources at risk by taking so much out of the company. Taxes payable, I would like to see them reconciled with what's on record with CRA. They're not always going to line up perfectly, but for instance, if I look at a December 31st year end, the HST balances should be reasonable considering what the final HST filing was for that business. It's commonly not completed by bookkeepers. We quite often get these and they're like, oh, well, your last HST filing was for $14,000, but according to the books, you owe the government $128,000. There's kind of a problem there when those kind of things happen. It does create extra work. Some accountants will just take those numbers, throw it into the tax return and file it, and then it's the client's problem. We don't really believe in that, and we want to know what happened, and we'd like to see that cleaned up. When you're doing journal entries directly into especially sales tax accounts, they aren't always captured correctly, so just be aware of that. And when you're reconciling those sales tax accounts, make sure that the interest and the penalties are put in a non-deductible interest and penalties category, because those, again, they'll quite often be blended in and shoved in like office, general and admin, things like that. Those are not appropriate. Equity transactions, those are, the issuance of shares, issuance of dividends, things like that. There could be a change in control that doesn't actually appear on the books. The number of shares doesn't change. So by looking at raw numbers, you would never know that the company got sold because the shares were sold from one private shareholder to another, unless you get the minute book, the sale agreement, things like that. These transactions tend to be infrequent, but they're key to understanding ownership. And in some situations, you can have loans that can get converted into equity. This quite often happens in startup situations where people are kind of working for sweat equity and building up a loan to the company that the company can either repay or convert to equity. If that does convert to equity, if that does get paid, it is a taxable event for that person who worked that. So that's important to make sure that those kind of agreements are well documented. So I talked a bit about the balance sheet accounts related to COVID. I would like to see the receivables in segregated accounts. It hasn't been indicated, at least I haven't seen that this is required but I think it would be helpful to understand cash flow. It would be helpful to understanding and being able to reconcile programs, things along those lines. Same with the payables, and that could quite likely happen. For instance, somebody who took too much TWS or something along those lines. Those things can happen, and they're going to, and they will get paid back eventually. So before I move on to the income statement, are there any questions about anything in the balance sheet so far? All right, on to the income statement. One of the key things we see is income. So passive income is a key thing. It's taxable at a different rate. Rental, royalties, interest, licensing fees, these are taxed at a different rate. They need to be segregated. We have lost business to accountants who have put their clients in jeopardy by declaring rental income as active business income. The client just sees that they're going to pay less tax, so they go for that, and hopefully CRA never catches on, but eventually I think they probably will, especially when they sell the properties that are being rented out, and that's going to come back and haunt. Passive income is a big thing in establishing value for a company. Although it's not passive income, monthly recurring revenue from bookkeeping is a key to valuing a bookkeeping firm, for instance. Product sales and services are active business income. Understanding where sales are occurring is very important in determining which sales tax should be charged. If you have e-com clients operating in the States, make sure they're tracking and understand the Wayfair decision. Companies are being pursued for this. And this is a common area of fraud. Again, people selling items off and just sticking the cash in their pocket, never recording the sale in the books. And how are you going to know without that inventory count? There are some items here with services that you have to understand. Is the owner operator serving a single client? Is it a personal service corporation, a professional corporation? And then understanding how time is used can help you serve the client better. We use T-sheets to understand how much time we're spending on stuff. If we find that we're spending too much time, it either indicates to us a broken process or more training is required. And it might just be that, some things are not worth taking on. And that's a pretty common conclusion that can come out of that as well. So the key expense accounts, legal, accounting, and professional fees, these should be reviewed in detail. Items might need to be considered cumulative eligible capital. Those are items related to the structure of the business or to incorporation, things along those lines. Some things might need to be capitalized as an intangible asset, things along those lines. A good accountant will ask to see all the invoices related to accounting and legal work. And yeah, sometimes we'll see stuff where we get it, and I'm sorry, your divorce is not tax deductible in the corporation. Things like that we've seen as well. So just make sure that the transactions being recorded are legitimate. All meals and entertainments need to be separated into different accounts. It's okay to have different types of meal accounts, but make sure that they are clearly identified. For meals, you need to write with whom you met and why. For the gifts, it needs to be who received the gift, and the contact info needs to be kept on there. You can do that in a schedule, but be careful of gift cards. I've heard of this happening a lot where, somebody goes out and buys $5,000 worth of LCBO gift cards, records them as gifts, has no schedule for that. And then CRA comes back and says, okay, prove to us who you gave those to. And when they can't, they go, okay, well, that was your personal expense. So that's going to be forced into your income. Vehicle expenses, I talked about this before. Make sure it's clear who owns the vehicle and book or don't book it appropriately. If it gets booked and taxes get filed, it can create quite a headache that needs to be navigated. Beware of how the HST is being claimed and keep those logbooks. I'd recommend, actually, we thought about it and speaking with some people who operate small fleets, it's a good idea to have that logbook go beyond the minimums and also include things like when oil changes are done, things like that. When breaks were done, any kind of incidents with the thing, like you got a parking ticket, things like that, can be helpful to keep track of those records as well. I know getting a client to keep a logbook can be a real pain. Everlance and MileIQ are two of the apps that we recommend for that. Yeah, so just some things there. All right. Okay, yes, Kim, the next poll is coming up soon. And yeah, I don't think we're going to run over. We're getting towards the end here. So penalties, interest, and other non-deductible expenses, these need to be recognized in separate accounts. These are the key, penalties, interest, legal settlements with CRA. These kind of items are typically not tax deductible. Neither are fines, parking tickets, moving violations, ministry fines, things like that are not tax deductible either. So the other income we've talked about a lot at the beginning. Those are some of these programs on CERS that was also identified. Thank you, Tanya. So were there any further questions at this moment about the COVID items and where those should be showing up? I think maybe Tanya, I need to attend your webinar on the COVID programs. That could be useful.
So yeah, I've actually gotten some emails on that. That's actually a CFIB webinar, this one in particular on Thursday. So if you're not a CFIB member, you actually can't attend, and it's full for those with the waiting list. So I can certainly put that link out there. Excuse me, but I will be taking very strict notes and putting notes out there for sure. And then of course, if anybody has any questions, or even if, we wanted to do one on COVID, because again, I'm attending 2 or 3 of these a week, anything that I can get into, which I've been lucky to get into some government ones. I'm certainly happy to arrange something like that, especially with the new changes. Now, just one thing to bring up, I guess Stacy's asked if I found the link yet. And I have been looking for the link. And I know it was on, and I can't find anything in CRA. It was on 3 different calls that they said it. It was a CRA representative directly, and one of those calls was through CPA that they did. But I cannot find the link that specifically, like it says that it has to be that it has to be reported when it's received, but there is nothing I can find on their website, because again, my argument was, well, the money's been received, but the forgiveness portion hasn't been received. And that's what what was my argument with them. But they're saying that no, when the money was in the year, again with this. So I can't find that. It was on Video Tax News, it was on the CPA Academy, and then it was on a direct one. So I do know I heard it directly from the top officials at CRA. So this was not a phone call into CRA, because I don't do that, because we know if we call in 3 times, we're going to get 5 or 6 different answers. So I do not call there. It was in a webinar with the head of CRAs directly, as well as a minister. One of the ministers. I've been on too many, I can't remember. So that's unfortunately all the information that I have to give now. Again, I can't find on CRA something where it specifically states in 2020, not when the forgiveness is received. So, but video
So
tax.
I've been looking to the Canadian Economic Response Plan website for data, and usually things link in from there.
Yeah.
I look in for there because it's written down. And people do make mistakes, and it seemed like overnight we ended up with 800,000 COVID specialists who knew absolutely everything, and quite frankly, it's a moving target.
It is.
It has been the whole time. Like we were laughing about this earlier in the year, how every time a politician went on television, we get 4 or 5 phone calls or text messages or emails asking about programs that aren't real yet. I know the latest ones still have not received Royal Ascent, or at least they hadn't as of Monday night when I last looked at it. So there was.
Sorry, which ones? Because Thursday night they did
anything included in Bill C9.
No, Bill C9 actually received Royal Ascent Thursday night.
Thursday.
Yeah, it was Thursday night.
Okay.
I did not, I checked on their website on Friday. It wasn't updated Friday. And then somebody said something on Saturday that it received it. And I was like, what? And when I went back and looked it up, and I've got the link to Bill C9, it actually did receive Royal Ascent Thursday night. They just hadn't updated it until late Friday.
Oh, okay. So maybe
Or
nothing was
Monday.
online about it that where I was looking anyway.
Yeah. So I can post the that I do have the link to that for sure. So we're for Bill C9, but yeah, it did absolutely approve Royal Ascent. There's not all of it did. I do believe the extra 20,000 and exactly how that's going to work was tabled, but it was definitely approved for the CUs 3 to June 2021. The CERS, which is the new Canadian Emergency Rent Subsidy, which that opened on Monday for filing. There's a lot of questions and concerns. So anybody who's smart, do not try to file for these things immediately, because they always find out that, oh, there was wrong information or wrong calculations, or nobody knows what's what. So I always wait a couple of weeks for their FAQs and everything to be properly updated. But then the CUs as well in Bill C9 for it to pause for periods, I guess, up to the end of December, to pause what it was for period 7 anyway. That was approved for at least for period 8. So period 8 falls into the same revenue, or sorry, the same percentages as period 7. And they updated it yesterday on the website with a new spreadsheet. So that's been updated for sure. So part of C9 has gone through and part of it hasn't, but I'll post the link directly to the what's received Royal Ascent.
Okay, I'm gonna hop ahead. I know Kim has to go right at 11. Obviously, there's a mistake with the next poll question, so I expect everybody to get the answer correct. No pressure.
Okay, so poll 2, Longit. Okay, great. So again, reminder that we need both poll questions to be answered in order to receive any CEC credits if and when approved. So we're at 64% there. And again, it doesn't have to be the right answer as long as we see that you're engaged in answering the questions. That is the main deal. Okay, so there's 2 people left. So maybe we'll give it 10 more seconds. Okay, we'll do a countdown from 5 and then we'll close it. So 5, 4, 3, 2, 1. Okay, polling is closed and there's the results.
Nice. Yeah, obviously have to focus on these part of the presentation definitely a bit more. Apologies for that, but yeah.
I didn't even notice that when I was copying and pasting it over this morning to set the poll up, and I didn't even notice.
Thanks, Lillian. Appreciate that comment. So just a quick note, if you fail to prepare, you're preparing to fail. I very much like to see these beautiful year-end files. We have seen some phenomenal ones. Just some quick comments. Things that make you look bad is not knowing what to provide and providing them piecemeal, not having the appropriate accounts reconciled. You might consider reconciling all accounts. You want to ensure that your books are perfect, reconcile everything. Not reviewing accounts to make sure they accurately reflect the position of the company. The most common place we see this is in prepaid expenses, and sometimes in that fixed asset category, the vehicles. Not reviewing balances to make sure that they make sense. There's nothing better than getting a balance sheet that has negative, credit position, AR, credit position, inventory and debit position, accounts payable. And I have seen files like that with no shares on the books either. Things that make you shine, doing it once, doing it right, giving that comprehensive package. It really makes you referable, and being able to be easy to work with makes it very easy to refer and to collaborate together. Reconcile those accounts. Said it before, I'll say it again. Review the accounts, make sure you've looked at everything. Any major variances, ask before the accountant does. If an accountant should be reviewing the year-over-year variances and asking, but if you can explain that ahead of time and answer questions beforehand, even better. And yeah, being ready for COVID reporting, because that's going to be fun times for all of us. So, are there any questions, comments, things that we want to continue to talk about? We did it just before 11, Kim. 4 minutes to go.
And I did post the link to the Bill C9 receiving Royal Ascent. So that link is there.
Awesome. Awesome. I'm going to open that and read that later. Oh, of course, it opens right into here. So, any further?
No, and I think the only thing we'll just ask out is for December. So we've got it currently, the next webinar scheduled for December 23rd. So it's just before Christmas. Is that a date that people will still attend?
Or should we just skip it and reconvene in January?
Yeah, exactly. So we'll put that up and general consensus rules.
All right, I got 3 skips in a row coming through chat.
Immediately.
So
Yep, 4 skips.
One fine to a 10. Kathy, why don't we just hang out?
Exactly.
We'll just hang out, have a cup of tea or a cup of coffee.
Okay, I'll post the link again because Jennifer didn't see the link. So it looks like the consensus is to skip and hang out with Kathy.
All right, I'm down with that.
All right, me too. Me too. Okay, so I will take the, just in case, I will also put the link to the Royal Ascent in the email. And of course, it will be in both emails, those for attendees and those that are just receiving the recording as well too. So people have that. Wonderful. And just have to throw out a quick commercial here. I'm actually doing a webinar on Thursday as well. It's an Intuit Business Builder webinar on tightening your engagement letters. So if you don't have an engagement letter, you don't know what to put in it, you don't know if it's good enough, you don't know how often. I've worked really hard on it. This is definitely a topic of passion for me. So go ahead and just Google Intuit Business Builder webinars and you'll see that, and you can apply, or sorry, you can register through there. There's some really good white papers, and like I say, I've worked really hard on this, and my mine have been reviewed by a lawyer as well. So this is, I'm giving all of that advice, exactly what to include based on experience, based on lawyer, based on my previous life in insurance. I did go to court on behalf of the insurance company several times. I learned a lot there. And then as well as disgruntled clients that I fired trying to challenge certain things. And I was successful every single time because everything was clearly spelled out. So again, you haven't registered. I don't know if there is going to be recording sent out if you're not there live. I know the white papers will be sent out if you register and you aren't there live. So I feel it's definitely worth it anyway to attend.
Yeah, and
I'll report back with information on the CRs, the CRs. Once I have that.
Means, would you work in a job without a contract? Why would you do work for a client without an engagement letter? I mean, for CPAs, you have to have it to be covered by insurance to be covered by the society, like to be in compliance with their requirements as well.
Believe it or not, out of bookkeepers that I surveyed, about approximately 50% of bookkeepers that I surveyed do not have an engagement letter. Out of those, approximately 50% that do use one do not update it regular. And it's maybe been years since it's been updated.
Yeah, you know what? Maybe Kathy, you and I can talk about that on the 23rd about things we do in our engagement letters that are kind of funny.
Yeah.
I have a question right at the beginning of my questionnaire survey, or my customer questionnaires. The first question is, are you happy and you know it?
There you go. There you go.
Just to kind of break the ice a little.
Yeah.
Okay.
All right. Okay.
All right. Well, thanks everybody.
Perfect. So everybody have a wonderful Christmas, I guess, because I'm sure we'll be talking to many of you shortly, but not on this platform anyway until January then. So.
Yeah.
Have a great Christmas. I will send the reminders, and yeah, we'll talk to everybody soon.
Take care, everyone.
Okay, thanks. Take care.
Bye.
Bye.